Today we start applying all the approaches that we discussed during the two previous lectures, time value of money, to the practical cases. And we start with the bond valuation. So at this moment, we have covered the mathematical foundations of time value of money. We know how to compute present value. We know how to compute future value in general, in specific cases of annuities, perpetuities. So it's time to apply this knowledge practically. So one of the most popular applications of present value concept is to compute value of financial assets, bonds, stocks, some other assets. So in this lecture, we start with the bond valuation. The next lecture, we will discuss briefly the stock valuation. Why briefly? Because stock valuation is a huge topic and basically it might be a separate subject of 15 lectures and exercise sessions. I'm going to discuss this during one lecture, just some general approaches. So let us start with the definition. What are we talking about? What is a bond? So a bond is a long-term contract under which a borrower agrees to make payments of interest and principal. So there are two types of payments, interest and principal, on specific dates to the holders of the bond. So generally, a bond represents a loan. So loan taken by a borrower and provided by the holders of this bond. This is something similar to credit. There are different types of bonds. Usually these types differ by their issuer of bonds. So government bonds issued by the federal government, usually. So we assume that these bonds have no default risk. What does this mean? It means that in principle, we don't expect that federal government will not be able to pay its obligations. Of course, there are cases. Some countries faced defaults, but usually in normal circumstances, we assume that there is no such risk. So corporate bonds issued by corporations. So these corporate bonds are exposed to default risk. So if a company gets into trouble, if a company receives no money, it might be possible that this company is unable to pay promised interest and principal payments. So there are also municipal bonds issued by regional and local governments, depending on the governmental structure of a country. And sometimes we also introduce the foreign bonds, which are issued by foreign governments, foreign corporations, in general foreign issuers. So all these bonds are similar in their functioning. The only difference of these four types is who issues and who is the borrower with the help of bonds. So we need to understand the key characteristics of bonds. The first is the principal. Also, you can see that it is called face value or par value. Those are synonyms. Principal, face value, par value are the same. So this principle represents the amount of money the firm, government, borrows and promises to repay on the maturity date. So this is the main amount of obligation. This is what you firm or government borrows and you lends to this party. Coupon payment is amount of money of interest each year. Sometimes more typically 6 months or 3 months, depending on the characteristics of this bond. So this is an interest. This is your additional profit that you receive for providing this principal to the borrower, similar to the bank interest. Coupon interest rate is a ratio of annual coupons to the principal, right? So if you want to compute the interest rate, you need to divide annual coupons by the principal. There might be different types of bonds according to coupon interest rate. There might be fixed rate bonds when the rate is constant. Might be floating rate bonds when the interest rate is floating. So coupon interest rate is floating. So it changes over time. And there are also zero coupon bonds, or sometimes they are called discount bonds, which means that these bonds do not have any interest, and the form of profit is a discount between the initial price and principal. The fourth characteristic is a maturity date. It is a date when the principal must be repaid. And market price. Of course, every financial asset must have a price which you need to pay in order to purchase this financial asset. So the market price for bonds might be denominated in monetary units, in rubles, yuans, rupee, dollars, whatever. Or it might be represented, and well, in many countries, this is the practice, the usual practice, to represent a market price in percent to the principal, like 102% to principal, which means that market price is 2% higher than the principal of this bond, or 98%, which means that the price of this bond is 2% lower than the principal. So in order to value bond, we must know all these characteristics but market price. Well, basically principal, coupon payment, maturity date are needed. Or coupon interest rate. One of these two. So let's see an example. This is a particular example of one bond issued by a company Whoosh. So maybe Whoosh, I guess Whoosh. Yeah. I'm not sure whether you've heard about this. This is the operator of electric scooters. This is a Russian company that operates a huge fleet of electric scooters on the streets. So those of you who live in Russia, you must be familiar to this. So this is the screenshot from Moscow Exchange terminal, and well, basically the link is working. We can open it, but you might be able to see different thing. So let's analyze what do we see here. So it was taken yesterday at 15:39. And what do we see here? We see that the price is 99.99. It's not in rubles, it's in percent. This is wrong information. So basically it's 100% below principal. This is the market price. We see profitability of this bond, 14.32%. We see maturity date, 25th June 2025. So it's 3-year bonds, basically. We see also here, we see coupon price, 33.66. So the amount of coupon, and the next coupon date, 28th December 2022. So here is some trading information, which is not that important for us at this moment. But here, where can we find the parameters of this bond? Also here, this is another table where we can extract all the necessary information about these whoosh bonds. So these are some formalities: security code, full name, registration number, ICI code. Here, 29th June 2022, date of listing. So this is the date when these bonds were issued on the market. So maturity date, we have seen it. Initial face value, 1000 rubles. Trading start date on Moscow Exchange. Okay, how many days do we have to redemption? So how many days is left to the maturity? Issue size, 3.5 million rubles borrowed. Sorry, it's not rubles, I guess it's in units. 3.5 million bonds. Each bond 1000 rubles, which means that the company borrowed 3.5 billion rubles. Yeah. Coupon payment interval in year 4, which means that company pays coupons 4 times a year. So 4 times a year, any investor is going to receive this 33.66. And coupon rate 13.5. This is annual. This is for quarter. Please don't be confused. So basically we take 1000, multiply by 0, by this. This is the annual amount of coupons, 135. Now we divide it by 4, 33.75. This is 33.66. So 9 kopecks. Have no idea where do they hide it. Maybe something like this, and then we can round this to 3.5. But of course you need to take into account this. So the 366. This is exactly how many rubles you will receive every 3 months. As I said, this is an e-scooter company operating in almost 40 cities across Russia. So what we have found for the bond is that principal is 1000 rubles, coupon interest rate is 13.5 approximately, right? So more correct, it's 13.46% per annum. 4 coupon payments per annum, so every 3 months. Coupon payment is 33.66 rubles every 3 months. Maturity date is 25th June. And market price is 99.99% of face value. So if you want, I guess, yes. So this is the last information for yesterday. So how many hours has passed? So it was taken at 15:39, and this data is for 18:49. So 3 hours passed, and you see that the price came back to 100% of a principal. So the price has changed. The market price has changed. Profitability went down 14.2 compared to what we had here. It's 14.32. So this is a nice observation. When prices go up, profitability goes down. We'll talk about this later. And yeah, so that's exactly the place where I found all the information. Okay. For the slides, you can see now days to redemption has changed. Now it's 998. 1 day has passed since yesterday. And what might be also interesting, well, here yesterday the minimum price of this bond has been 99.05 and the maximum price has been 125 in percent. So we have found a particular financial asset. Now the question is, how should we make a decision? Should we buy this bond or not? And more important, if we buy, how much we are ready to pay for this bond. Because if you want to buy, you need to make an order, you need to place an order on the stock exchange. And in that order, you need to specify what price you are ready to pay. And this is exactly the question of a bond valuation. How should we determine the price that we are ready to pay for this bond? As we know from 2 previous lectures, the value of any financial asset is calculated as a present value of the cash flows this asset is expected to produce. We did it several times. We had several examples, and this case does not differ from the previous ones. The cash flow from a specific bond depends on its features. So on the characteristics that we have discussed on the previous slide. So if there is a standard coupon-bearing bond, so the cash flows consist of interest payments and amount borrowed, or principal. If there is a floating rate bond, the interest payments will vary over time, will be changing. In the case of a zero coupon bond, there are no interest payments, only the face value amount when the bond matures. That's all. So this is a general scheme of cash flows from bond. We have timeline 0, 1, 2, 3 up to n, capital N, which is the date of maturity here. And we have interest payments here, 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 up to the end. And also we have a face value here, it's capital N. So int is a periodic coupon payment. RD is a discount rate that is gonna be used to calculate present value. N is the number of periods before the bond matures, and M is the principal or face value of the bond. So that's the structure of a cash flow. We know how to compute present values. So then the computation of a bond value becomes very simple. So given those parameters of a bond, the present value is computed in the following way. We take the first coupon payment, expected, divide this by 1 plus RD to the power of 1. Second coupon payment divided by 1 plus RD to the power of 2. Third, fourth, fifth, sixth, and so on, up to the last interest or coupon payment divided by 1 plus RD to the power of n plus face value, which is capital M in this case. Now, according to the specifics of different types of bonds, we can simplify this formula. If there is a fixed coupon bond, we have a case when interest 1 equals interest 2 equals interest 3, la la la, equals interest n. How do we call this cash flow? Who can help? Friends, how do we call a cash flow when all payments are equal? Any ideas? Anybody, please? Students from the first group who already had exercise session. The cash flow with payments of equal size is annuity, and we know how to compute the present value of annuity. So all this long sequence of terms converts into one short formula. We can compute present value of this stream of interest or coupon payments like this, using the present value formula. And the last term, principal, must be evaluated separately. Well, now, if there is a zero coupon bond, which means that interests are zero, or coupon payments are zero, the formula transforms to the simplest possible case. These terms are zero, and we are left only with the principal, which must be discounted. That's why this bond is called discount bond, because your price you pay is always less than principal. This is the only case where you can get some profit from this bond. Now, let us apply this approach to the particular bond of this company Whoosh with the following parameters. So what do we know about this bond? We know that the principal is 1000 rubles. We know that the coupon payment is 33.66 rubles every 3 months. We know that the maturity of this bond is 3 years. when the bond has been issued. At this moment, today, the maturity is shorter, but let's abstract from this. Let's take the simplest possible case. Suppose also that the return of the similar bonds is 12% per annum, which is the discount rate for our case. This is RD, 12%. The alternative that you can get if you choose not this bond but some other bonds. So first of all, very important step. You must start with the transformation of necessary characteristics according to the periodicity of coupons. So what does this mean? Maturity is 3 years, but payments are paid every 3 months. So we need to convert maturity, sorry, it's not M, it's N, capital N must be. Principal doesn't change. So capital N must be converted according to this, to quarters. And RD, 12% per annum, must be also converted in quarters. So again, who can help? If maturity is 3 years, how many quarters, how many coupon periods do we have? If there are 3 years, but coupons are paid every 3 months, how many coupons will be paid? Guys, this is very simple, even simpler than annuity. How many quarters in 3 years? Come on. Say it aloud. Don't write to chat. Turn on your microphone and say it. Guys, arithmetics. Simple arithmetics. How many quarters is in 1 year? Okay, quarter is 3 months. How many quarters is in 1 year? How many periods of 3 months is in 1 year? Guys, are you okay there? So again, sorry for the typo, it's not capital M, it's capital N, number of periods, it's 12 quarters. Now, if the interest rate is 12% a year, this is the annual interest rate, how much percent per 1 quarter do we have? Guys,
It's 3%.
It's 3%. It's 12 divided by 4. Thank you. 3% a quarter. And now with these characteristics, we can apply the formula we have seen on the previous slide. So we need to take every payment, it's quarterly payment. divide this by 1.03 quarterly discount rate to the power of 1, 2, 3 up to 12, because after 12 quarters this bond is going to mature. Now we see that this part is what? Again, can somebody repeat? What is this part? What is special about this part? How do we call this part? Cash flow with equal payments. How do we call this part? Okay, so this part is the present value of annuity. We can convert this to the following form. And finally, after the calculation, we get this 1036.43 rubles, which is the maximum possible price that we are ready to pay if our required return is 12%. So if I'm happy with receiving 12% a year, then I am ready to pay for this bond at most 1036.43 rubles. This is going to be my order to buy the bond. Of course, if the market price of this bond is 1000, as we have seen from the Moscow exchange page, my return is going to be larger than 12%. Now, suppose that due to the better economic conditions, market interest rates decrease. What is the present value of a WUSH bond when the required return is 10% per annum? Please calculate yourself what is going to be the present value if the interest rate changes to 2.5 per quarter. So just change everything in the formula, like not everything, but 3% in the formula to 2.5% in the formula in order to get the result. So the price is going to be higher. Now it's not. So the previous one was 1036, now it's 1088. That gives us the following very logical relation. If the required return is 12% per annum, the maximum price is this, 1036. When the required return is 10% lower, the maximum price that you're ready to pay is higher. Right? It is logical. If you require less, you're ready to pay more. And it leads us to the following question. How the bond price depends on the discount rate? Well, the relationship is very simple. So when interest rates rise, bond prices fall. When interest rates fall, bond prices rise. That's what you probably can hear from some economic or financial news. Like the interest rates on the market rise and prices of bonds go down. So this is the graph for our particular bond, for the WUSH bond, if the interest rate changes from 0% to 20%. If it's 0%, it's just the sum of all coupon payments plus principal here. And then you see that the price declines when if the interest rate, if the discount rate increases. Somewhere here, market price is equal to the principal, and this is 1000. This is related. This is around 13%. Exactly what we have seen on the page. The interest rates on the market are changing constantly, and we want to know what is the sensitivity of a bond price to the interest rate. So this sensitivity mathematically can be measured with the derivative. So derivative of a function. So basically we know that if the bond price is given by the following expression, so we know that we calculate the bond price using this formula. And now we see that one particular variable, exogenous variable in this formula. Exogenous means that this variable is not set by an issuer of a bond. It is not set by the buyer of a bond. It comes from the market. So if this interest rate changes, present value also changes. And derivative in mathematics, in calculus, shows exactly how the linear rate of change of a function with respect to the variable. So when we take the derivative with respect to the interest rate, we are getting the following expression. So I'm not going into details. How do we get this? If you remember mathematics, nice. If you don't remember mathematics, just trust me that this is the derivative of the previous function with respect to RD. Again, this represents how much present value changes for small deviations or for small changes of RD. If RD changes by a small amount, present value changes by this size. Now we are going to transform this formula slightly to get something practical. And yeah, so we have this derivative. So now we will transform this formula in several steps to get something practical. First of all, we will factor this thing out. What it gives us, first of all, we get rid of these minuses in front, and then second, in the denominators, we have the usual exponents 1, 2, 3, up to n, right? So we get rid of one extra exponent here. So second step is to divide both sides by PV and multiply by DRD. So look, on the left hand side we have this fraction. D is delta, D is a change. So this D represents change. On the right hand side we have this change in RD. Now we have an interesting thing. Let's try to decompose this formula into something. So this term on the left hand side is the relative change in bond price. So basically, how much percent this bond price would change. Here we have a change in interest rate. Let's say from 12% to 10%. It's minus 2%. And this large fraction is called a duration. Or sometimes it is called a Macaulay duration, after the person who proposed this formula. So this Macaulay duration is simply the following thing. And you see that with the help of this Macaulay duration, we are able to make a forecast, a simple forecast of bond price changes. So let's see how this works on our example. So let's compute the duration for the Woosh bond at RD equals 12%, and then let's apply this to compute the changes in prices. So here is a table. It is better to represent cash flows of bonds in the form of table when we compute the duration, because now we are not able to simplify this computation with the help of annuity or whatever. So we need to separately take every payment. So here we have a stream of payments. All the time the payments are equal 33.66. 1, 2, 3, 4 up to 11. And the last period, the payment is 1033.66 here. Then we separately compute present values of every single cash flow. And here we see the total price, exactly the price that we have computed several slides ago, 1036.43. Here in the last row, we compute present value multiplied by T. Let's see why. Because here every element represents exactly a single present value. And then this single present value is multiplied by the period number, 1, 2, 3, and so on. So this is what we do here. And the sum is 10,476.62 from here, right? Now we have this sum. We have a present value. We can divide this by this. And the result is 10.11 quarters. This is the duration is computed in quarters. So by the way, we can look at the parameters of this bond, and we probably will be able to find the duration. I'm not sure whether they report duration or not, but if they do, I must be able to find it. No, I don't report it here. Okay, it doesn't matter. For some bonds, they do. For some bonds, they report this duration. Okay. So now let's see how we can practically apply this duration. So when, remember the previous task, when the interest rate falls from 12 to 10, in quarterly interest rates, it's from 3 to 2.5. So the change in the interest rate is minus 0.5% per quarter. Now, what is the relative change in price according to the formula from the previous slide? We are taking this term minus 1 over 1 plus r, this one. Then we take this duration, 10.108. And then we multiply by the change in the interest rate. Of course, we need to transform this from percent to decimals. And the relative change in bond price is 4.91% here, plus 4.91%. So the last step is to compute how much is this in rubles. We multiply this by the initial price, have 50.86 rubles, and then we add this to the base price. So the new price is expected to be 1087.29. So remember that we computed the exact present value to be 1088.83. So we see that with the help of duration, even especially when the duration is reported to you and you know this number from the stock exchange, for example, it is very simple to forecast your new price. But this is going to be approximation. In reality, the bond price is going to be different, usually slightly higher than the one computed with the duration. Again, if you need to know the exact present value, of course, you need to compute this present value with the new interest rate. If you want to approximately estimate a new price, then you can use duration. And the duration is a very popular measure of risk associated with the bond. So that's why I decided to show you this measure here, because if you would ever encounter this duration in your real life, you will understand why do we need to know this duration. Any questions regarding duration, computation of the duration, and its applications?
We have no question.
So to conclude, what we have covered in this lecture. So first of all, we know that the value of a bond is computed as the present value of its cash flows. And we know that usual bond produces interest payments during the life of the bond and plus amount borrowed. So coupons plus principal. There is also a useful parameter called duration, which we can use to measure the price sensitivity of a bond. And also we can use this to approximately compute a new price when the interest rate changes. The last thing is home assignment number 3, time value of money, second part, based on the material of the exercise sessions that we have today. So exercise session number 4, you will have some exercises about annuities, about perpetuities, and growing cash flows. So this is still October 8th. Please, again, keep in mind that home assignment number 3 is going to be available till 10 a.m. next Saturday to prevent you from doing home assignment during the classes. Questions?
No, it's clear.
Good. So thanks for your attention. Thanks for your participation. I hope that next classes your participation is going to be more active. First group, have a nice weekend. Second group, see you in 15 minutes on the exercise session.
See you, Professor.